Hi, investors. It's Nick Garner here from InvestMore. And today we're going to do a little bit more digging around some of the data that we've got. We're going to look at different sets of data, compare them against each other, look at where there are close relationships or not, and from there then draw some inference and meaning, which then helps guide investment decisions. So one of the things I like about all this kind of stuff is it's based on data. So it's not my opinion, it's what the data shows us. And as a general rule, successful investors are led by the data, and then they use their cumulative experience within property or stocks or shares, whatever it is, to then come to a overall conclusion. But having data like the stuff we're going to show you is just very helpful for getting your bearings. So let's get into it. What I've done is taken the postcode district data from propertydata.co.uk. So we use quite a lot of their data just for general analysis and so on. This is a very small data set. So it's just all the postcode districts in the UK and excluding Scotland, I think. And then it's these metrics aggregated. And from there, I've done some correlation analysis. So the reason I think this is useful is because it just shows you general relationships between different variables that occur within the whole property ecosystem in this country. So there will always be anomalies, and working at this super high level where you literally kind of zoomed out and looking at the whole country helps you look at stuff in a very, like I say, a very broad way, which means you can set these rules up and you go, okay, I know that this correlates with that, thus it's a rule. And when I'm thinking about stuff on a lower level, I'll remember that rule. That's roughly how it goes. All right, so let's get into some of the variables. This obviously postcode district. Then we have 1, 3, and 5 year capital growth. The capital growth numbers are not what I call real numbers. They're not inflation adjusted. They're just nominal capital growth figures. That's a whole topic in itself. The one around inflation adjusting capital growth to work out whether you have really advanced in real terms on your property investment or not. But for now, we'll just use this. And this is okay because what we're looking at is relationships between stuff. So it's indicative, and that's okay for what we need to do. Next is obviously asking price. These are the averages of properties that have been put on the market, and it's the average asking price for all those properties within that given postcode district. Sales per month will be just obviously the absolute number of sales for a given month. Turnover is quite an interesting one. This is the percentage of properties based on total stock that have been sold each month. So in other words, if you've got 100 properties on the market somewhere and you sell 10 of them, that's 10%. That's 10% turnover. Average asking rent is fairly self-explanatory. It's a bit like asking price in that it's the rent that's advertised. Now, what I notice with average asking rent is that that's not necessarily the rent that's agreed upon between tenant and landlord. We will never know what that number is because it's private. But at least we can work with the average asking. And generally speaking, you can say that the average asking price for a property is typically 5%, 4 or 5% higher. So on average, the actual sale price for a property is usually negotiated down by about I think it's like 4.1%, something like that. There are some stats out there showing these figures. And you can say that average rents are going to be negotiated downwards as well. So it all kind of evens itself out. That and for the purposes of this correlation analysis, that's just fine. The next thing is the average yield, which is the gross yield. So that's going to be the asking price over the advertised rent. Again, if you were being really specific about it, you would say that this is just not quite there. But the reality is that everything it's a decent approximation. The other thing to remember with yield, of course, is that if you're if you just look at gross yield and you ignore property condition, renovation costs are going to massively affect the true yield figure. And so for me, there's gross yield, there's gross rentable yield, i.e. properties ready to rent, and this is what the property costs plus the refurb. And then you've got net yield, which is obviously minus all your costs, and you can have net yield before tax, after tax, or whatever. So there's lots of different ways of looking at it. But approximate yield is fine for what we're doing here. Turnover rental is very similar to turnover sales. It's number of properties rented out based on a proportion of properties rented out based on stock available during the month. So the way this works is that we would analyze all the properties that are for rent in a market, and we would then we would look at them all and we would work out which ones have disappeared at the end of each month. And from there, we can see roughly what the turnover might be. And this is what property data do, and we do as well when we're making doing more granular assessments of a given market segment or whatever, or area. Okay, crime rate is number of crimes listed per month, as far as I know. I'm not 100% sure on that. But again, it's not that important because what we're more interested in is the relative amount of crime compared to one postcode district or another. If you notice, you can see here, that's a lot of crime, but that is also B2, which is city center. And in city centers, you got a lot of nuisance crimes, shoplifting, theft, things like that. And so these would be reported crimes, not necessarily investigated or concluded crimes. Population, self-explanatory. Degree, this would be the percentage of population in that postcode district who have a degree. AB is an interesting one. So this is social grading. The UK government use a social grading system where they say that if you're social grade AB, for example, you would be senior professional, company director, somebody who makes a lot of money. And the and going further down the chain, if you beyond that you have C1. C1 would be a professional, that might be an marked like a manager somewhere. C2 might be a tradesperson. Then D would be a casual worker. This might be somebody on zero hour contracts. And then E would be people who are typically unemployed. And this whole area around demographics is really important in that it gives us great insight into given areas and where to buy, where not to buy. And one of the other things as a side note is that demographics don't change that much in a given area over the decades. So it's social grade is well, you'll see in a minute how it correlates. It's really interesting. Well, I think it is anyway. Okay, household income, that would be the aggregated household income by single earner or a couple or whatever, but the overall income into the house per year. Bedrooms, self-explanatory. Social rent, this is the proportion of housing stock that is available as social rent. So in other words, it's local authority housing, that kind of thing. And one of the interesting things about that stat is that whilst the information is nearly a decade old, i.e., it comes from the 2011 government census, social housing just doesn't change very much. Like the stock change, it really doesn't change much from one decade to another these days. There was a big sell off, maybe, what was it, 30 years ago? One of the earlier Conservative governments did a big initiative for people to buy their own council properties. But once that subsided, then social housing remained pretty static. And there's some very interesting correlations between social housing and poor capital growth, high crime, poor good yields, but unattract these places are very, if there is some private renting within an area that has a lot of social housing, typically we tend to avoid those areas. So we'll get into that in another video. Okay, private rent is the proportion of property in an area, in percentile terms of in an area, okay, that is available for private renting. So before we get into the spreadsheet stuff, let's talk about correlation and what it is. Essentially, it's the relationship between two sets of numbers. For example, in this web page here, we've got two sets of variables. We've got elevation in feet and we've got temperature. And whilst it's all very mixed and all over the place, broadly you can say that there is a correlation, an X% correlation between the two. So maybe the higher you go, the colder it gets, for example. And when we're analyzing property, it's the same old story. What we're looking at is the relationship. Just getting the spreadsheet up here. We're looking at the relationships between one set of variables and another. And to make this easier to work with, what I've done is I've created a grid, and you can see the grid here. And the grid works by using the correl function. So in fact, I'll zoom it out so you can see roughly how I've done this. So for example, if you look at the correlation between here, this one here, 1 year, 1 year, well, yeah, because it'll correlate 100% because it's the same set of data. But I've then created another column here, and we've got the correlations between that, and it just kind of carries on. So what I've done essentially is I've created a grid, and I can look at the correlations for all of these variables in every combination. And then from there, I've color coded it so it's easier to read. And then I'm able to go in and just see what the relationships are. And from there, it's very easy to look at patterns which are kind of, as it were, universal to the whole of the UK property market. And this is an important thing because when you look at it at a very high level, you're able to create rules, as it were, which are universal to property. So when you zoom down into specific situations, there'll always be variables and stuff that you might not have thought about. But as a general rule, these are really good rules to follow. We went through the variables and what they mean, and now we'll look at the relationships. So we can say, so this one is quite interesting. Well, I think it's interesting. Hopefully you do too. One of the things that surprises me a little bit is how longer term capital growth, whilst it correlates fairly highly, it's not 100%. It's not near 100%. So what this tells me is that you can have short-term growth wherever, a little spike of growth in some place for some reason. Good example is Blackpool. There's been a lot of growth recently there. But long-term growth has been dire in Blackpool. Like if you go back from 2007 to date, it's been appalling, in fact. You know what? It's easier if I just show you a map. So I'm going to do that very quickly. And that way then can move on from there. So Black Liverpool has done very badly. This is real capital growth from 2007, and in other words, if you bought a property in 2007 at the height of the previous market and you sold it today, in real purchasing power terms, you would be down on average 25%. If you're living in Blackpool, it's more like 35%. Or if you were in the worst patch here, you might lose around half. Now, saying that, very recently growth has increased. So that's good. But whether or not that's a good long term place to put your investment, I don't know. I don't think so personally. But anyway, the point is that long and short term growth don't necessarily correlate. But if they do, then that tells me that this is a robust area that sees steady growth. The Okay, so the main point is yes, all of these correlate closely, but they don't correlate as closely as you might think. So short-term growth, long-term growth, it just because it's grown a lot recently doesn't mean it's a great area generally. So be aware. The next thing is the asking price. Now, one of the things that's quite interesting about this is that growth, from what I'm seeing, when you look at so statistically, if it's below 20%, let's say, or 20% or below, it's not statistically that meaningful. And what you got here is just averages all over the place. So the average is 0%. What that tells me is what I've already known actually, is that capital growth isn't just found in really good areas. You can have declining capital growth in high-end areas in a city that's, say, failing, for example, failing economically or whatever. So capital growth is found at all price points in the ladder. The trick is to identify those spots where growth has been solid over the long term, affordability is reasonable, and people want to bid the price up to live there because it's a nice place to be. But the usual myth is that you get the most growth with the most expensive property. Well, yeah, so you buy a property for £500,000 and you get the growth on 500,000, which means you make more money. And if you can gear up and get a high loan to value, that makes a lot of sense. It's quite risky. It's more risky, but it makes sense. Versus spending £100,000 on a property. But the point is that £100,000 property could grow at the same rate as the £500,000 property. So capital growth isn't just it's not just found in cheap property or expense. It's just everywhere. But it's with capital growth, as I said earlier, when you look at the maps and so on, capital growth very is actually oops um, capital growth is not universal. I mean, yes, you get growth in line with inflation across the country and so on, but overall, it's not a foregone conclusion that if growth is good in the country, that it's good everywhere in every area. It's just not the case. So Liverpool has suffered badly over the last 30 years. And you can see that Manchester has done relatively well, for example. And there are lots of areas which have really done badly, unfortunately. So Tyne and Wear, I think that's Tyne and Wear, but these kind of, here we are here. Most areas have not done great when you look at the long-term picture. Now, obviously, as an investor, you're going to get in at whenever you're going to get in, but the question is that place going to do well in the long term? And the answer from the data is that A, not necessarily, like it doesn't really correlate long to short term, but B, buying the most expensive house that you can possibly get just because you think you're going to get proportionally more growth on that one is not necessarily a good idea. It might be much smarter to buy three properties at 150 that produce a better cash return than lump all your money into one high value property, because actually those three properties will probably get the same capital growth, relatively speaking, if you buy in the right area. Moving on, sales per month. Again, that's quite interesting in that there isn't really a massively strong correlation between sales per month and capital growth. So areas where there's a lot of growth, you'd kind of think that property would turn over much, much faster, but that doesn't seem to be the case. The higher the asking price, the lower the turnover, the sales turnover in an area. That makes sense because property is more expensive and therefore less accessible to the majority of the population, thus less turnover. The rent 90% correlation, of course. So higher the price, higher the asking rent. Higher the price, lower the yield. Well, again, we know this. Um, this is, and also higher the price, lower the turnover, the lower the rental turnover, which is also kind of interesting. So again, all these things make sense. There's nothing counterintuitive with this. The other thing which is important is the relationship between a higher asking price and demographics. You can see here that areas where property is more expensive, you're going to have people with more education, higher social grade, and higher income. And so this is all fairly obvious. But what's nice about this data, sorry, I'm just organizing this here for you. What's nice about this data is that it validates that idea. So one of the things that we are fixated on within the business is identifying areas where there's growth, where there's higher social grade people that are more economically productive that can sustain a serious downturn. So COVID is a good example. Like, who were the people that could keep their jobs and keep marching on? Well, higher social grade people typically. This is also quite interesting. So the higher the rent, the higher the demographic, and the higher the rent, the more private renting, there is. There are certain areas which just work for renting. And one of the good things is that it's quite easy to get this information to work out which areas are popular for renting or whatever. And I suspect that that's what that's about. Rental property kind of aggregates in certain places, and therefore they tend to get a higher rental because they're just better for renting versus a house in the middle of the countryside that is miles away from any amenities. On the demographic side, we go higher the yield, lower the demographics. And here, for example, we go higher the yield, higher the crime. And again, that kind of makes sense to me because high yield properties are generally in higher crime areas. And social rent, poorer areas have more private renting overall. And so higher yield will correlate with higher social renting. And then obviously higher yield, more private renting. As you can see, there is a lot of information here, and yeah, it takes some getting through. Okay, rental turnover. The higher the price, the lower the turnover. That makes sense. The people generally correlate crime with bad areas, but the reality is that it doesn't matter what area it is, whether it's, say, Fitzrovia, for example, which is in central London. This has some of the highest crime rates in the country and some of the highest house prices. Crime and area don't correlate. And when we analyze crime, we typically look at crime in a very hyper localized level. So, what we're interested in is a large amount of crime in what should be a very quiet area. Then we know that there's some issue with gangs or family terrorizing a neighborhood or something like that. And that makes people's lives hell. And those kind of places are an absolute avoid. Expensive areas in city centers can have just as much crime as bad areas or poor areas in city centers. It's just city centers. And then you've got the suburbs, which are quieter. And even if it's a poor area with low social grade people, you will very often find virtually no crime. And then by the same measure, you can look at high social grade areas out in the suburbs, and again, no crime. This is why the correlations are all a bit weird. And the big rule that we follow is it's not crime itself, it's the perception of crime that really frightens people. And the answer is you got to look at the crime data and hyperlocalize and look at the patterns, which we do. Okay, so the next thing is, I'm just going to make that a tiny bit smaller so you can see all the stuff on it. The next thing is, let's move that across. Yeah, there we go. Okay, and private rent, and that's an exact inversion. So um, the more private renting there is, the more crime there is. But that's not because people who privately rent are likely to do more crime. It's simply because private rented properties are more central very often, and therefore there's more crime the closer to a city centre or town centre you're in. That's what that's all about. All right, so rounding all this up, we see obviously correlations between capital growth, short and long term, but the correlations aren't as high as you might think. And that's why one has to look at the big picture with growth, i.e., the long term picture, and then kind of zoom back down. It's very important to look at it from an inflation adjusted point of view, because when you have an area that is doing well in real terms, then people must have more wealth than they did before, which demonstrates long term economic growth, which is an important thing to factor in. The next thing is that crime happens everywhere. Of course, the higher the demographic, the lower the yield, and so on. So, as an investor, the question is like, what's the perfect formula? Well, the perfect formula is as high demographic as you can possibly get, as high a yield as you can get, and as high capital growth as you can get. The usual idea in growth is I buy into the very best area I can, and it's going to definitely grow. Here, for example, the data says that's not the case. And based on the data we've got, we know it's not the case. Okay, just to round all this up, we've got a few key points here. We've got capital growth, short term, long term, they don't necessarily correlate. Therefore, what I would say is look at the long term picture and inflation adjust that so you can see real economic growth versus nominal growth. And if an area is working long term and short term, then you can be fairly confident that it'll continue to do well, relatively speaking. There's obviously a huge correlation between asking price and higher asking price, lower yields for higher demographic people. That has a load of implications. So the other thing is crime, and how crime is not that correlated with anything in particular. So you can have expensive areas with high crime, poor areas with low crime, etc. And it all kind of balances itself out. The the so with all that in mind, when you're thinking about an investment decision, I would always aim for the highest demographic I can get interested in my property. So if you think as an investor, I buy a property, I rent it out. And if I buy a property that good higher demographic people want to live in, then then I'm more likely to get somebody who's not going to lose their job, that's going to pay their rent, that's going to look after the property, and so on. And the mistake a lot of people make is they just chase raw yield, forgetting that actually there are problems with dealing with the economically vulnerable. So, uh, and the other thing is crime and the perception of crime. The answer is you won't know until you look at the crime data as to what's actually going on. And with crime, what we always do is look at very localized crime. So we look at, for example, if there's an area and if there's a housing area and the crime stats are very high, where is the crime occurring? Is it in the shopping precinct down the road? Is it within the actual housing estate, and so on? And what we're always interested in is crime which shows that maybe there's a gang or a family that's terrorizing a neighborhood, and if that's the case, we just avoid, because we can't get rid of those people to make the area nicer. That's the job of the police, and they're not going to do that either. So sadly, so we look at crime in a very localized way, and for yield, we there are good deals out there, but generally speaking, what we find is that the best deals are areas that the main herd of investors aren't looking. So Corby is an interesting area for me because it's got very good long-term, short-term growth. Demographics are about right for renting, and it's a 50,000 person town. So who's going to go and find out what's going on there? Manchester is very heated, but it's also very economically robust. And in another video, we'll get into some more of that detail anyway. So, okay, I hope that's helpful, and keep on investing. Thank you.